Along with the rest of the globe, it's a rising tide, and sure enough, we as well are catching up. Devina Mehra joins in right now on the show to talk about where she sees the market headed next. Devina, hi, good morning. Good to have you on the show. Devina, where do you think the Iran-US deal is going to lead the markets? And can Nifty realistically move as other world markets are?
Morning. I don't think we should only depend on the deal. But yes, I mean, if it happens, it takes away a big overhang overall on all markets. I don't think that's what's going to drive the Indian markets up. I mean, even in March, when I think I had come on your channel, I had said that the market looks on all our indicators as if it is in the bottom range. I can't tell you whether it will start moving up in 2 weeks or 2 months, but you know that the indicators are all positive. And even now, if you see, it's a very different market from what it was in 2025. So in 2025, actually all the Indian indexes were up, but the median stock was down, and 40% of the stocks were down more than 10%. But midway through the year, the outperforming stocks were only about 15%. The norm is around 40%. Now we actually have a majority of the stocks outperforming the indexes. So it's completely flipped, which is good news overall for markets, and which is why, as I said in March, also had said that don't be 100% in equity, but whatever is your equity allocation, remain invested. So that remains my advice.
So you're saying to remain invested, do we also look at increasing the equity allocation so that given the fact that you have a geopolitical risk now at the verge of getting over, and the only thing which now is which the market should be looking at is the earnings growth?
Actually, the geopolitical risk per se is not something you should react to. And this I'm not saying now. I mean, there's an early March video of mine, which actually is pinned on my Twitter feed, which says exactly that don't overreact to geopolitics, because this is what 125 years of data shows, including the 2 world wars, the 2 Gulf wars, the US bombing Libya, 9/11, all of that. The markets shrug it off, even when the conflicts continue, as has happened with Russia-Ukraine. In fact, the first time I made that video was the day the Russia-Ukraine war broke out. So that's, of course, in India, there is a direct impact because of the crude, because that that impacts the earnings. So that is, of course, you have to take that into account. And good news on that is good news. Of course, you know, we've gone through so many ups and downs in this resolution. I think it's the 29th time it is supposed to be resolved. And even now there are some things saying that US has agreed to compensate Iran for the damage, and someone contradicting it. So, you know, let's see wait for it to be signed, sealed and delivered, as they say. But that is not what I am betting on as far as the Indian markets, or for that matter, the global markets are concerned.
Hi, Devina. This is Harsh. What's the most dangerous consensus trade in markets today? You're known for this, so give us your call right now.
So, I mean, actually, if you look at the markets last couple of months, the SIP numbers have turned negative. The number of accounts, at least, have turned negative. And generally, Indian investors have been very jittery. And if you plot long term, always you will see the mutual fund inflows peak around market peaks and bottom out around market bottoms. So just as you saw in January, the gold inflows into the gold funds peaked. That was it. That month, it was more than the equity inflows. And January was the peak of gold prices. Since then, the rupee has depreciated. Since then, the import duties have gone down. So not just in dollar terms, even so, the rupee price of gold also has corrected. So this is the whole issue that humans act out of their emotions, which actually mislead you completely. So in 2024, it appeared super easy to make money. Now, when you are panicking is when you need to be remain in the market. You know, that is the superpower, that do not get out when your mind is screaming, get out. So that's a general thing. And as I said, that in March itself, I thought the market was at the bottom range as per all our indicators. So, and also I have been saying since then that the one thing which has changed again in a year and a half ago, every fund manager, every expert on your channel would be selling, quote unquote, the India growth story. And suddenly in the last few months, everybody started enumerating the risks that suddenly India has become a no-hopper market with too many risks. And sentiment is always a contraindicator. That's the research studies show all around the world, whichever country it has been held, that when sentiment is overbuoyant, the next period returns are below normal. When sentiment is very negative, the next period returns are above normal. So in terms of probability, anyway, I was looking forward to a better year than the one that has gone by this financial year.
Devina, for as long as we've chatted, you've always maintained that don't put your eggs in one basket. And, that's beautifully played out, especially since the last 1 year. A multi-asset, multi-geography strategy is what's really worked well for investors. Should investors realign, rejig their portfolios at all, or stay put with that kind of allocation wherein you have exposure to US and other Eastern geographies and other asset classes as well?
No, you should always have a diversified portfolio, but I will repeat, since we are talking global, that the US is not the globe. People think that buying a US index or a few, everybody knows the 7-8 US stocks and 3-4 Asian stocks, and buying that will save you. That is incorrect. It is better than being in only one market, what I call SCAR, single currency, single country, single asset risk, but not a whole lot better. So last almost year and a half, we have been underweight US. We went overweight Europe. We were overweight China and some other markets. And so you have to have a diversified portfolio. I mean, in our last global rebalance, we added markets like Malaysia and Mexico, which are below the radar for everybody. And also the thing is, people think very simplistically that you buy what used to be called still called the Magnificent Seven, which is the 7 major US tech stocks, Meta, Apple, Amazon, Microsoft, Google, Nvidia, Tesla, and you will be fine, which worked out very well for 2.5 years. So 2023 and 2024, more than 50% of the S&P move was just these 7 stocks. In 2025, the bull started to tire. So it was 40%, of which only Nvidia and Google outperformed. Now, 3 of those 7 are down for the year, which is the reason, and they have contributed only 6% to the S&P move. And that's the reason S&P has actually hugely underperformed the US small cap index, which is Russell 2000, which is up about 18-19%. S&P is barely in, I think the S&P is now in 8-9% range for the year. So that's the thing, the baton has already passed on, but people are still, I had earlier done a post where I got AI to generate a caricature of a person driving backwards. So, the peaking of gold in January, and for example, now this thing that you could get by with buying those stocks, or now everybody thinks that you buy semiconductor stocks and you are done. And that's the whole point, that semiconductors, people have not studied the industry to know how cyclical semiconductor and semiconductor equipment industry is. It goes through huge ups and downs, and which is also the nature of one, the industry itself is capital intensive, and then it is dependent on the capital expenditure of others. So this year, the AI and data centers spend maybe $800-900 billion, but will it be more than that 2 years ago, 2 years later? That's the real question. So, the point is there are no easy answers, and that's why, I'm a little skeptical about all the gift city schemes being launched by people who have no expertise in global markets, and which shows up in the results also. Most of them are down for the last 6 months because they've invested in yesterday's stocks. They were not even keeping track of what's happening, rather than, even not, let alone look into the future. So be very careful also about how you go global. It has to be with somebody who has real expertise.
What would you propose, Devina, if not just the US equities? Where should Indian investors and retail investors in particular be looking at upping the global exposure now that the big overhang of US and Iran is behind us, hopefully?
So, Aisha, the thing is that this has been a cause for me. As you said, I have been saying it for years. I have not just started saying it because the Indian market has not done well. And what I have done what I could, which is offer a product to Indian retail investors, which starts at $10,000 and in all countries, meaning all geographies, as well as all assets, which starts at $10,000, which used to be 7.5 lakh rupees not very long back. Now, unfortunately, it is 9.5 lakh rupees, but at least get started, because when I started working, the dollar was 12 rupees. So you cannot plan for long-term financial goals, which are 10, 20, 30 years later, without accounting for this fact that the rupee depreciates.
Devina, you spoke about dollar at 12 rupees. If you had taken a position on dollar, you would have gained more, right?
So, I mean, last 1 year, for example, I was just doing that exercise for a newspaper interview, and my India equity portfolio did nothing. India multi-asset was up 7%, but my global assets were up 42%. So on the average, because I'm more global, I made 37% in rupee terms. So, that's what a diversified portfolio gets you.
You can give us a sense of what should be the portfolio mix at this point in time. You have global events now. You have more clarity on global events at this point in time. You have more clarity on where Indian earnings are also going, and you're trying to tell us that hold on to your equity position, not take it up. But then what should be the portfolio mix or asset mix? Let me put it this way.
See, asset mix really depends, it varies for everyone, because it varies according to when you need the money. So obviously, anything in equities, I say don't put anything which you are going to need in any circumstance within the next 7-8 years, because equity is not predictable. You cannot plan that I'm going to buy this house a year and a half later and put the money in equities, because you don't know year and a half later the money might actually be down. So that is the nature of equity market. So don't put anything you need. So that's why it will vary from person to person. As far as global is concerned, if you're going purely objectively, most of your investment should be global, because India is only less than 3% of the world market cap, and you are already overexposed to India in a sense. Your home is here, your business or job is here. So actually, like for me, it was 80% plus global, which now, because of last year's price movement, has become 85% plus. But at least aim to get 30 to 40% of your portfolio in global assets. That's it. At least, that doesn't appear like an outrageous number, though, as I said, objectively, it should be even higher.
Devina, thank you so much. Need to cut this conversation short, but thank you so much for coming in and speaking to us this morning.
Thank you.